Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome back to the show this morning. It is, of course, Thursday, second best day of the week, and we've got a lot of stuff to talk about this morning. We know a couple of things with certainty today. The first thing is that forever is not forever. Forever 21, the clothing store, filing for bankruptcy. Yeah, being put out of business by Temu and Shein, right? So Shein is the Chinese company you can order really cheap crap off of. And listen, my wife, and if your wife hasn't discovered Shein yet, okay, I'm just saying, you can buy boxes full of jewelry for like $1.50, right? I mean, just truth. It's pretty incredible. Anyway, Forever 21 filing for bankruptcy. That was actually announced a couple of days ago, but I forgot to get to it. We also know that today is the first day of spring. So that also means that our best friend, pollen, comes back into town. Our little yellow friend.
Yes.
So this is the time of year where your car is just covered literally in pollen. But we do not have it as bad as other states, right? So there are other states. There's actually a survey out this morning. I think like Rhode Island is number one. They've got like the worst pollen count. So
I would think Kansas or Nebraska would be.
No, they're in there, right? I mean, but you think we have it bad here. There's other states that have it worse. So, but anyway, spring is here. That means the blue bonnets are coming back. Don't pick those. State flower, right? I always wonder, is there like police that like walk around and look for people picking blue bonnets? Really? Seriously?
Her name is Karen.
Her name's Karen. All right, but we do have a lot of stuff to talk about today. Obviously, we'll get into the whole Fed announcement yesterday. what he talked about. Jerome Powell, of course, yesterday talked about, and there was no rate cut as expected, but did kind of reaffirm we'd have 2 rate cuts this year, but had a lot of changes to the actual Fed statement itself. And that immediately led to an explosion of mislabeled headlines. And so we'll get into all that this morning and get through that a bit more. But the good news is that, markets found some footing yesterday. We'll talk about that in a moment. Outside of that, economic data continues to be okay. We have seen quite a bit of economic data this week. It's been fairly heavy. And there's really nothing alarming within the economic data itself. It's pretty much status quo. So while there's been, kind of a lot of concern during this recent decline in the markets about a tick up in recessionary fears, et cetera, really hasn't shown up in the data yet. Now, it doesn't mean it won't, right? It doesn't mean that we can't have a recession. It doesn't mean we won't eventually get there. But for right now, that data is not there. Now, as we're starting to move into the last 2 weeks of the month, we are starting to lose stock buybacks as companies now start to close down. We talked about a little bit yesterday. Earnings will kick off in April. Estimates have been coming down a little bit. We haven't seen a huge reduction in estimates for the first quarter. They've come down some. And as always the case, if we look back at March of last year versus where we are now, there's been a decent decline in earnings estimates going into the beginning of first quarter earnings announcement season, but it's not been dramatic. And again, if you were expecting a recessionary downturn, and if the economy was getting dramatically weaker, as kind of what a lot of the headlines have stated, because of this recent decline in the markets, you'd have expected a much bigger set of cuts to earnings, because again, where do earnings come from? Earnings comes from economic activity, right? So, that hasn't happened yet. So between the economic data and looking at forward earnings estimates, we don't really see rising concerns about a recession. So, and this is why it's always you always got to be careful with headlines. We as humans, we have to assign a reason. Why is this happening? Oh, well, it's because of recession. But there's really no evidence of that data yet. Doesn't mean it won't change in the future. And the next month we could be standing right here talking about, hey, well, all of a sudden we got this big tick up in recession because of whatever reason. That's just not the case right now. So we just have to continue to kind of monitor those things. So here's what you need to know before the bell this morning. So absolutely yesterday the Fed came out and reestablished a bit of the Fed put. Now what is that? The Fed put is a is a mythical belief. It's not really. Starting back in 2008 during the financial crisis, the Fed stepped in, of course, doing quantitative easing 1, and then of course we did quantitative easing 2, 3, 4, 5, 12, as we kind of went on. Every time the market would decline, the Fed would step in some shape, form, or manner, whether it was Silicon Valley Bank crisis or whatever it was, and kind of step in to support the markets. During 2020, stepped in with $120 billion a month in QE during the pandemic. All kinds of support for the junk bond markets, etc. We've seen this over and over again. And this is because as markets decline, what the Fed's concerned about is that will lead to a loss of consumer confidence that will impact the economy and potentially lead to some type of credit-related event within the economy that would impair the banks. So the Fed tends to step in during a moment of crisis. Now the problem with that is it's created moral hazard. Moral hazard is where investors now believe that they are insured against losses, and so now every time that the market goes through a minor correction like we just saw, everybody starts looking for the Fed to step in and kind of bail them out of excess risk taking. Now at some point, this is not a healthy aspect to the overall markets. We've turned the markets into a casino where people are taking on excess leverage and risk because of this moral hazard that the Fed has created now by stepping in to support the markets whenever markets decline. Well, yesterday, the Fed kind of sort of did that a little bit, and we'll talk about this in more detail, but they kind of stepped in yesterday, provided a bit of a Fed put. Markets rallied pretty sharply off of that. And again, we're getting very, very close to a buy signal here. So we've talked about this before, is that if we go back and look at time, when you have these signals at very, very low levels, those typically tend to be near market lows. And again, just like over the last 3 years, we haven't seen a signal on momentum at such a very deep level as we're seeing right now in the markets. And again, but historically, whenever you have these very deep signals, those have been near-term bottoms to markets. Now, it does not mean necessarily that you're off to the next major bull market run, but it does suggest that when you have signals and appreciated momentum as much as you have at this moment in such a deep signal, when that turns positive, that has been a decent tradable buy signal for the markets near term. Now again, if we go back if you're in a longer term correction like we were in 2022, we saw those same type of signals. They gave you decent rallies to trade out of positions, to rebalance risk, reduce your exposure to markets, etc., before the market declined again, went to a new low, and then you got the next rally. If we're entering the beginning of a bigger corrective cycle, which is possible, I'm not saying it is, but it is possible, we never know until we're actually in the midst of this thing, you're still going to get a rally here at some point because of these deep oversold conditions. And we're starting to see these improve somewhat. Relative strength is picking up here. We're starting to see better performance across asset classes. We saw money flows yesterday tick up positive, and particularly coming back into the mega cap stocks, which have kind of been the market leaders as of late. They're doing a little bit better here. But again, this improvement in relative strength along with this potential buy signal here is a tradable potential if we get it. Now again, it's possible this morning futures are turning lower. We'll see. If markets roll back over here, again, we can keep this signal from happening. But if this signal triggers, that's going to be a pretty good entry point to add some exposure for a tradable rally. That's the key here. We may get a tradable rally back here up towards some level of resistance, but that'll give you a better opportunity to rebalance risk in your portfolio, raise some cash if you want. If you are worried about a bigger decline, you wait for that rally to kind of give you an opportunity to do that. So that's what you need to know before the bell this morning. We'll come back and we'll talk a little bit about what the Fed said yesterday, what it means, and is there or is there not stagflation? That's the headline that's all over the place right now. So we'll talk about that right in a moment.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Good news and bad news. Good news is hey, we're here. Bad news is Michael Leibowitz is not, so you're stuck with me this morning. I apologize. But he's here in spirit because we'll talk about the Fed, right? So we can get through this. So yesterday, of course, the Federal Reserve did two things yesterday, which they do once a quarter, which is they release their quarterly projections, which is their estimates for what inflation, PCE, Fed funds rates will be this year and next year and the year after, and then the long term. So they kind of give these long-term projections. These projections are never correct. They are never right. I'm not sure. They started doing this in 2011 under Ben Bernanke, and this was after the financial crisis. They thought it'd be a good idea if they started providing these projections because it would give some policy certainty or visibility into what the Fed was thinking, et cetera. But as with all things, humans are fallible, and trying to predict anything more than about 3 months out is kind of just throwing a dart at a dartboard. And so these projections are never correct. They're always overly optimistic. Things always turn out worse than expected in most cases. But, you know, this is a new habit that they've gotten into about giving these projections. So they gave them yesterday. And it was interesting in the projections that they noted that long-term economic growth is now going to move down towards 1.7%. That's coming down from 2% previously. So again, now they're getting a little bit more dire about their long-term outlooks, but those long-term outlooks are really just kind of moving back to where they were prior to the 2020 pandemic, where we had this massive surge in economic growth. Everybody got all excited because they thought it was organic growth, and it was really just stimulus-fueled growth from all the spending that we did. So now we're just moving back to the long-term trajectory of where economic growth was already headed because of, as we talked about before, debts and deficits lead to slower economic growth. So now the long-term projections are coming back down to those slower levels of economic growth. And again, 1.7% is not good, right? That's not a good rate of economic growth. Historically, you need 2% economic growth just to maintain the employment market relative to the increases in the population through immigration, natural birth, etc. So just 2%, if you're getting just 2% growth, all you're doing is basically just replacing dying workers with new workers. So you're just creating enough economic activity just to remain stable. At 1.7%, you're below that level. Again, as we talked about before, I think we noted this with Danny, I think, yesterday, is that prior in the 1900s, way back when, 2% economic growth was considered pre-recessionary. And so now we're just hoping to have 1.7% economic growth. So that certainly isn't suggesting that the economy is going to take off to the races. We've gotten adapted to just thinking that 2% economic growth is a good rate of growth. It's really not. But it's not negative. So we'll go, there's your positive spin for it today, right? So it's not negative. They also noted, though, that inflation would stay around 2.8% this year, and then would fall back to 2.2% next year. Immediately on that announcement, when those announcements came out, the number of stories in the media absolutely exploded with the rate of with the headline stagflation. And that's not the chart, Brent. That's the Fed put. We're not there yet. It was stories, but that's a different story. We're going to get to that different story in a minute, right? So, but the number of stories, but the chart. Honestly, I could put up that same chart that Brent just showed you real quick, which is the number of stories on the Fed put. It's the same with stagflation. Yesterday, there was an absolute explosion of stories with the title stagflation. All of them wrong. We do not have stagflation. Stagflation, by definition, is not slow economic growth and high inflation. That is incorrect. And anybody that publishes a story from Zero Hedge to CNN to CNBC, which CNBC did this yesterday, they had a story out right after the announcement talking about stagflation. Let me see if they've still got it posted. No, they took it down. Somebody must have called them on it. I wonder who that would be. But they had the story out, headline, Fed sees stagflationary concerns. Big headline. And the issue is that, first of all, you need high inflation. High inflation is not 2.8%. That is not high inflation. The average long-term inflation rate since 2000 is 2.4. We've been below that. We've been a little bit above that at times. But 2.8%, 3% inflation, 4% inflation is not high inflation by any stretch of the imagination. 1970s, 14% inflation. That's high inflation. Not 4, not 3, not 2.8. Those aren't high inflation. So no, you do not have stagflation at 2.8% or even 3% inflation. That is not stagflation. You do not have stagflation with economic growth at 1.7%. You need closer to 0 for stagflation. We don't have that. Right now, economic growth is running over 2%. Now, it's not great growth, as I said, but it's not stagflationary growth. So just saying that that the economic growth will slow a bit and inflation will remain sticky is not stagflation. Yet every article on the planet came out yesterday saying, "Oh, the Fed fears stagflation." That's wrong, because there's a third component to stagflation. Stagflation is not low economic growth and high inflation. It requires 3 components to have stagflation. Stagflation also requires high unemployment. So I need an environment where I have above 5, 6, 7, 8% inflation. I need near 0 or recessionary economic growth. And I need high unemployment, 8, 9% unemployment. That's stagflation. Unemployment right now is near the lowest levels on records. Inflation is near the long-term average. Economic growth is near the run rate that we've had since 1990. There is no evidence of stagflation in the economy anywhere. Oh, and for all you egg people, egg prices have come down. But there's no signs of stagflation. But again, this is what we talked about the other day about headlines, right? That's a great headline. That got all kinds of clicks and views and everything else. They're wrong. Every single article that was printed yesterday talking about stagflation was wrong because they don't understand the basic definition of stagflation. But it got great headlines, got great clicks, got great views, scared the bejeebers out of people. Right? Got people to take action. Wrong information. But it got great headlines. But they also noted a couple other things in there. Now you can bring up this chart. There was also another surge in headlines yesterday about the Fed put. What is the Fed put? As I talked about just a little bit here at the open of the show, is ever since the financial crisis, every time the market has declined by some amount, everybody starts looking for the Fed to step in and kind of bail risk-taking out, this thing that we've created called moral hazard. And particularly in an environment where you have so many people taking on excess leverage through option trading or 2x levered ETFs, 3x levered ETFs, just all kind of margin debt, etc. When markets decline by 10%, their losses are a lot greater. So again, when I start losing a whole lot of money, I really start kind of hoping somebody's going to bail me out of my stupidity. And so we've all gotten used to and accommodated to looking for the Fed to bail us out of our stupidity as investors. And so yesterday, when the Fed made their announcement, there was a surge in the number of media stories accounting for the Fed put. Now, why would that happen? Here's what the Fed said. Now, let me back up before I get to what the Fed said. What's been going on for the last year or so, right? Fed's been hiking rates. and they were reducing their balance sheet, right? Remember that every time we've had, this surging bull market over the last 15 years, the Fed's been doing what? Keeping rates near zero and doing quantitative easing. This is where the Fed basically buys assets from the banks. They credit their reserve accounts at the banks. The Federal Reserve takes over the bonds. They hold the bonds on the balance sheet. Well, over the last year or so, they've been reducing through what's called quantitative tightening. They've been allowing their balance sheet to decline, to shrink as bonds mature. They weren't really ever selling bonds. They just allowed the bonds to mature and they just didn't replace them. So this led to a decline in their balance sheet. That's been weighing on liquidity for the markets. In fact, a lot of liquidity has been pulled out of the markets over the last year or so because of the end of spending programs, the bailouts during the pandemic. Of course, the Inflation Reduction Act, et cetera, that money has worked its way through the system. So that lack of liquidity has certainly been a concern for markets. So we'll come back and we'll go over what the Fed said yesterday about the Fed put and why the markets are responding the way they are. We'll come back and talk about that next, right here on The Real Investment Show.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm sure when you were growing up, your parents said, don't get in a car with a stranger, especially white vans with no windows on them. Don't get into those if they're offering candy.
The Real Investment Show podcast.
And then now we've evolved to this point. It's like we can order a stranger with a car to come pick us up off of our phone. Uber just announced that they are opening up a wait list for Waymo rides in Austin. This is the driverless taxis, which is cool.
At realinvestmentadvice.com.
So now I'm not going to get into a car with a stranger. I'm just going to get into a car with no driver and watch a Roomba go around Austin trying to navigate busy streets.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So headline on the news right now is that Trump is going to sign an executive order today to abolish the education department. We've talked about the issue that since 1980, when the education department was first kind of put into place by the government, that the ranking of the U.S. in terms of education, particularly in math, science, and STEM type of studies, have declined sharply worldwide. In fact, right now the U.S. ranks like 21st or 22nd. I don't know the exact number, but we're pretty far down the list in like math, science, those type of things. We used to be ranked at the very top. We're now very low levels. So, and again, if you take a look at 8th grade reading scores across the country right now, they're pretty abysmal. So the Department of Education has certainly failed at their job of educating our youth. And so this will be an interesting step to abolish the education department and move it back to the states and allow the states to take back control. In fact, the state of Texas has been working very hard to provide more ability for parents to have the choice of where they educate their children, whether it's homeschooling or whether it's charter schools or whether it's public schools. So, one of the things that has always been of great debate is whether or not the public school system is the best way to do it. Should you introduce competition into the school system to where, again, parents can choose where to, again, whether or not you have, and this may not be the case in every state, but in Texas, you pay school taxes regardless of whether or not you have kids going to school. So if you own a house, you pay school taxes. And it doesn't matter whether you have kids or not going to school, you're still paying school taxes. And if you choose to send your kids to private school, you pay for private school and you still pay public school taxes. So one of the things they're trying to do in Texas is allow parents to at least use a portion of those school taxes at their discretion. So this has been a debate for the last several years here in Texas, and they've been trying to get something passed to improve the education of Texas citizens. But again, this abolishment of the Department of Education could have pretty profound reaches in terms of allowing states to take better control and actually forcing states to take control of the education process in their states. So this is going to be this will be an important shift, and it'll be interesting to see how this all works out. Anyway, let's go back to the Fed. So the Fed yesterday talked a little bit about this. We just finished up a second ago talking about, that every time there's a decline in the market, there's, the Fed has always kind of bailed everything out. And so now investors have been trained to just expect that every time there's a disruption, the Fed's going to step in. And they have, right? We had the Silicon Valley Bank crisis, a couple of years ago, and the Fed stepped in with the bank term funding program, bailed out all the regional banks. It was a great buying opportunity. Everybody says, oh, the regional banks are going bankrupt. We bought some regional banks, great trades, right? So those type of events are typically really good opportunities. And so this recent decline, a whopping 10% from peak to trough, has gotten investors going, oh my gosh, when's the Fed going to step in? This is just crazy that they're not going to bail this out. We just can't stand much more of this normal, everyday, run-of-the-mill type decline. Just that cannot happen. And of course, yesterday the Fed didn't make note of this. In support of its goals, the committee decided to maintain the target range for the Fed funds rate, 4.25 to 4.5, right? So didn't change the Fed funds. And considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Now, what that meant is they're leaving 2 rate cuts on the table for this year. The timing of those cuts are unknown at this moment. Could be next meeting, could be meeting after. There's still 4 or 5 meetings left this year. The committee will continue to reduce. Now, this is what got everybody excited. The next sentence. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Okay, that's quantitative tightening. Beginning in April, here's the line. The committee will slow the pace of decline in the securities holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. That's a $20 billion decline in their redemptions. What does that mean? So, as I said in the last segment, the Fed is not this was one of the myths that was going on for a long time. It's like, oh, the Fed's selling, the interest rates are going to go to the moon now because the Fed's selling treasuries. No, they were never selling treasuries. They were allowing bonds to mature and then just buying what they needed to maintain their balance sheet. So the Fed's still been buying treasuries, right? So if I have, so again, they were allowing $25 billion a month to roll off. And so let's say that last month, just as an example, they had $40 billion worth of bonds that matured. They would only replace $15 billion of that. So they were still in the markets buying bonds if needed to maintain their balance sheet with the exception of that runoff. So now they're going to reduce that to just $5 billion. So they're going to reduce that runoff to just $5 billion a month from $20 billion. Now, they're not doing anything to the Treasury, the mortgage-backed securities. So mortgage-backed securities and agencies are rolling off $35 billion a month. But that's a very small portion of the balance sheet relative to the Treasury debt. So they're going to still let that mature for now. That'll eventually change as well. But what got everybody excited yesterday is now this redemption cap reduction to just $5 billion from $25 billion now puts the Fed in a position potentially to start buying more treasuries if they need to. Because again, they're probably going to have more than $5 billion a month maturing. But this is that first step of ending quantitative tightening. And this is what got everybody excited yesterday. And this is why everybody started talking about the Fed put again, because now this is the first time that we've seen the Fed start to reverse course on this extraction of monetary liquidity from the markets, which they've been doing. So now instead of hiking rates and reducing their balance sheet, we're now cutting rates and now slowing the reduction of the balance sheet. The next step obviously would be what? To start increasing it again. So this is that first step towards that. Now, again, this is what got everybody excited. The committee, of course, they reiterated we're still focused on 2% inflation. We're still focused on stronger economic growth. We're still focused on full employment. That didn't change all that. But again, this is what got everybody excited. Yesterday, the markets rallied really strongly after the statement came out, sold off a little bit right into the end of the markets. Again, the futures are pointing a little bit lower this morning, but we'll see if buyers step in here today. But again, this is kind of unfortunate that we're in this situation, which is where, investors have gotten themselves. Again, this is what I was saying earlier, is that, we've gotten so used to the markets being bailed out that we've created this environment where we just speculate and gamble, and we're no longer investing. And this makes it hard. We've got so many influencing factors in the markets. And this is why you've got to be so very careful about headlines and what you listen to, because a lot of the stuff that you hear kind of in the media headlines will A, never happen, or B, if they do happen, aren't of the magnitude that people expect them to be. Ray Dalio has been running around lately is that we're about to have this huge financial crisis because of the debt. Well, he's been saying that since 2010, right? He says it almost every year. I'm doing an article. I've got all of his previous headlines that he's put out there. But if you were listening to Ray Dalio and his views on the debt and things, you've missed huge rallies in the markets. I can't tell you how many times he's called cash, cash is trash, cash is king, right? It's back and forth, right? And generally when he says cash is trash, that's the best time to be in cash. So, this is why you've got to be so careful of headlines. And again, with the markets are paying attention to liquidity. They're paying attention to earnings. They're paying attention to short-term outlooks. And again, because the markets have become such a speculative environment, not an investing environment, a speculation environment, a lot of this stuff that you listen to, the narratives have no bearing on what's happening with the prices. Because again, what drives prices up or down? It's just simply buyers or sellers. That's it. Now, you can try to attach a narrative of that. We've talked about that before, is that as humans, we have to have a reason why things are happening. Why is the market declining? Well, it's because of a recession. No, it's just that you have more sellers than you have buyers. Why are markets advancing? Because you have more buyers than sellers. Why is gold up? Because you have more buyers than sellers on the futures exchange. Gold prices are controlled by futures. So the more commodity buyers you have in the futures market buying gold futures, it's going to drive the price of gold up. Same for stocks, same for bonds, same for everything else. If you've got huge shorting positions against treasuries, you're going to have yields go up and bond prices go down. It's just buyers and sellers. It's just the market. And again, we have to, as humans, we need a reason for that, right? Why is this happening? That's okay to try to assign a reason or a thesis to it, but in most cases, it has nothing to do with the reality of what's actually happening in the markets. It's just how we as humans have to try to rationalize things. So as investors, this is why we always come back to the basic premise of this is why you got to manage risk. When things are really overbought, really extended, really deviated from long-term means, take profits. When things are really, really oversold, that's the time to buy stuff. It's always very interesting is that, humans do the exact opposite. We sell the lows. We buy the highs because we get trapped into these narratives instead of understanding what drives markets ultimately over time. All right, quick break. Be back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Switch gears here a little bit as we get ready to wrap up the show. So, as you know, on spring break, I took the kids and my wife. And this wasn't my idea, by the way. I got roped into this. But we went skiing, and we went to Colorado to Beaver Creek to ski. I've never been there before. It was very interesting. Really nice place. If you know, of all the places I've skied, or I don't ski, I snowboard with my kids, but my wife skis. She's such a wimp. Anyway, just teasing. But anyway, so never been there before. It's great. Really long slopes. Wasn't very crowded at all. But when we came into town, so our flight left at 4 o'clock in the morning, 4:15. So we got into Denver about 7:30ish, right? So it's 7:30, 8 o'clock. And so we got into Denver, landed, went and got the car. Of course, you know, we've been up since, 3 o'clock in the morning, really kind of 2 because we had the hour change, right? Daylight savings time. So I'm still missing that hour somewhere. Anyway, we got there and everybody's kind of getting hungry. And so, we've talked about the future of work here on the show and kind of where we're headed. And this is kind of my first real experience with this that I've seen, personally. I've read articles about it and I've seen it, in videos and other stuff, but I've never personally experienced this. But we were leaving the airport. And so as we got our car and we were leaving the airport, and everybody was kind of getting hungry. And so there wasn't much around the Denver. When you get in the Denver airport, which, by the way, apparently on a square mile basis is larger than San Francisco, according to one of my kids that were looking at on Google. I don't know if that's true or not, but it's a huge airport. I mean, and there's just massive flat land. As you leave the airport, they're starting to build some buildings out there, but it's just, as far as you can see, pretty much just flat land until you get to the mountains. And so there's not a lot out there. And so one of the first things everybody saw was a McDonald's, and there's a new McDonald's just got built. And so my wife's like, yeah, we'll just pull in there and get the kids fed, and then we'll get on the road. Cause it was like an hour and 50-minute drive from Denver airport to Beaver Creek. So we pull into McDonald's, park, we go inside. There's no reason to take notes on this, Brent. There's not a funny story coming out of this. We're just talking about the future of work. Brent's over here feverishly writing notes. Denver Airport, McDonald's. Anyway.
Couldn't remember the name of the resorts. Beaver Creek.
So we go inside this McDonald's, and there's nobody in McDonald's. I mean, nobody. There's no customers. There's no people. There's just a bunch of kiosks. And it was interesting because all the tables in the McDonald's all had charging stations on. This is how bad things have gotten now. All the McDonald's tables now have in this McDonald's had charging stations where you could set your phone down on a magnetic charger. It would charge your phone. You could plug it in. And so apparently, so you can eat and take pictures of your McDonald's food and post it on social media. Like, this is an important thing. But, it's just this kind of just evidence of where we are. We're just so attached to our phones. But anyway, there's just kiosk to order with. So you go in and you order on your kiosk, right? And you get everything done. And then it gives you a number. And then the one human that I saw in this whole McDonald's, maybe there was 2. There might have been some guy in the way back somewhere that I couldn't see. I only saw one human. He brought our food out to the counter where you have to now get up from your table and go get the food at the counter and bring it back, right? They still want a tip, by the way. But it was interesting because it's no longer the McDonald's that we used to see where there was a bunch of staff, working, cooks, cleaners, whatever. This and the bathrooms are very clean, very modern, everything else. But it was interesting, right? Because, you've now removed all of your cashier work from this process. You just basically have your line cooks in the back preparing the food, and they bring it to the counter and they just set it on a tray on a counter, and they, you go get your food. But that just got me to thinking, about the future of work and where we're going. And, the impact of what this means for the driver of the economy, which is salary and wages. as we've talked about before, economic growth, and again, the Fed comes out yesterday, talks about 1.7% economic growth. That's not a good rate of economic growth. But that's where we're headed, because if you don't produce first, you can't consume. Well, we're just eliminating more and more jobs through the advancements of technology. And look, I'm not saying that's a bad thing. I'm not saying the advancements of technologies are terrible. It's the end of the world. My dad was convinced when, back in the 80s that computers were going to put him out of a job. 20 years later, it did. But, the interesting aspect of this is that the jobs that our teenagers used to rely on coming out of high school to, work summer jobs, those type of things, pay their way through college, whatever it was, those jobs are going away. And it was interesting because there was a Wall Street Journal, and the reason I bring this up is there's a Wall Street Journal article out this morning talking about, thanks to NVIDIA, AI will soon take your order at Taco Bell and Pizza Hut, right? Yum Brands, owner of Taco Bell, let me just read to you from the article real quick. Yum Brands, owner of Taco Bell, Pizza Hut, Kentucky Fried Chicken, and Habit Burger and Grill, which I didn't even know that was a thing, announced today it's partnering with NVIDIA to build a range of new AI-driven services at its restaurants. The first AI-powered voice ordering at the drive-thru lane and on the phone was built by Yum developers using tools and development frameworks from NVIDIA, and they will begin rolling this out at 500 restaurants across the portfolio in the second quarter of this year. The ultimate goal is to move all orders through digital channels instead of what? Human order takers. An effort by Yum that says it will boost sales. It will also boost profitability. Why? Because I don't have to pay a human order taker anymore. But those are jobs that are lost. And so when you start kind of extrapolating this out and go, okay, how do we get economic growth that creates economic prosperity? I have to go to work every day. I have to produce something in order to get paid. Once I get paid, I can go consume something. I can go to Kentucky Fried Chicken or Taco Bell, and I can buy a taco or I can buy a piece of chicken, right? So I spend my money at Kentucky Fried Chicken or at Taco Bell, and that's how Yum Brands makes its revenue. So, yes, that's all great. The problem is I just now put a whole bunch of people out of work who no longer have a job. So where are they going to go get a job? I mean, human order takers are not a high-skill job. These are jobs that our teenagers should be doing. These are jobs that, our first-time job workers, right? This is, and again, we talked about this before, is that, there's this whole cry about minimum wage, right? We need to pay, we need to have $15 an hour minimum wage. No, right? Your minimum wage is based upon your skill set. If this whole idea of a living wage is complete nonsense. You're not supposed to be on a living wage being a human order taker at Taco Bell. That's your first job. That's you learning how to work in an environment, take orders from a boss, work with a team, show up on time, do those type of things. You do a good job, you get promoted, and you start making a living wage, right? But the minimum wage is a test wage. Let's see how well you perform. And then once you perform and you can show up on time, not cause problems, those type of things, not steal from me, then I'm going to move you up into a more responsible position and pay you more money, right? But if you don't work out, I don't have a lot on the line. You don't have a lot on the line. We just part ways and go our separate ways, right? That was the fallacy of the $15 minimum wage. But now we're removing those key jobs. We are now moving those jobs from that are good learning positions about how to operate within a business, how to work with a team, how to take orders from a boss, how to show up on time, how to go above and beyond on a job to show your worth. We're taking those away. Now, the immediate argument to this is always, well, there'll be other jobs. Yeah, there's going to be some other jobs. But AI isn't just affecting Taco Bell and Pizza Hut. It's affecting every company. And this has been going on for decades. We've talked about before is that, used to you had live receptionists. You don't have live receptionists. When was the last time you called somebody and somebody picked up the phone and said, "Hi, can I help you?" Doesn't happen anymore. First thing you do is you call somebody and say, "Do you want to speak English or Spanish?" Right? I don't even get just English. And I live in America. So but we replaced all those jobs. And this has been going on for decades, right? We just keep replacing more and more jobs. And so the problem, and again, this is the thing we have to think about, is that the employment side of the economic equation is critical to having economic growth and prosperity. AI is great. It can really enhance the productivity of Americans. It can make us much more productive, make us much more intelligent. It can do all these things for us. But it also has a very dark side that we have to be careful of because of the impact to economic prosperity. Just something to think about. Anyway, have a great day. We'll be back on tomorrow, of course, with Richard Rosso and, do we know? Who knows? Somebody. Richard Rosso will be here tomorrow for Financial Fitness Friday. I'll be back on Monday. And in the meantime, have a great weekend as well. See ya.